All right, we are closing the books on the first quarter of 2026, and really the only word for it is a reckoning. It's been a period of just intense volatility, driven by some massive forces that we really need to understand to have any clue what comes next. So let's break it down.
We have to start with this number because, honestly, it's defined everything. 55%. That is the gain for oil in a single month. I mean, that's just a staggering move, and it sent shockwaves through pretty much every other asset out there. And, while energy was just exploding to the upside, the broader market was feeling a very different kind of pain. The S&P 500? It's closing out the quarter down 5.1%. That's the brutal contrast that everyone's facing right now.
So, what in the world is driving all this? Well, it really boils down to two huge interconnected problems. You've got a geopolitical conflict that's basically shutting down global trade, and you've got a central bank that is completely and utterly trapped. These are the big themes we're going to unpack.
Okay, first up, let's dig into what is, without a doubt, the most important story of the quarter: oil's just unbelievable historic surge.
And here's the hard number that you just have to know. Brent crude, it closed yesterday at $112.78. That single price is the anchor for inflation fears and economic anxiety all around the globe. Now, to put that 55% monthly gain in perspective, this is what's so wild. It's not just a big number. It is the largest single-month surge since the Brent contract even launched back in 1988. This move is actually bigger than the price spike we saw during the Gulf War. That's the scale of the disruption we're talking about here. And the driver behind it all? It's the same story. It's the Iran-Israel war, which is now in its 5th week. And because of that, the Strait of Hormuz, this critical choke point where a full 20% of the entire world's daily oil supply passes through, is effectively closed. You just can't reroute that kind of volume overnight. It's impossible.
So what could actually reverse this? What could bring prices down? Well, there are really only two ways this gets better. First, some kind of major diplomatic breakthrough, a formal ceasefire. Or, second, the shipping lanes are physically secured and reopened for business. As of right now, neither of those things looks like it's happening anytime soon. Okay, let's pivot now to our second story and see how this massive energy shock is translating into some serious quarter-end pain across the stock market. And man, the report card for Q1 is just brutal. We already mentioned the S&P is down 5.1%, but the tech-heavy Nasdaq? It's in official correction territory, down over 10% from its highs. And on top of that, we've just lived through the longest weekly losing streak for stocks since 2022. There has been absolutely nowhere to hide. Now, there's something very specific about today's trading that you've got to understand. It's called quarter-end rebalancing. So think of it this way. These giant pension funds, they have really strict rules about their mix of stocks and bonds. At the end of every quarter, they're forced to sell what did well and buy what did poorly to get back to their targets. It's not a choice, it's just a mechanical flow of money. And this lays out exactly what that means for today. Because of how things have performed, a lot of these big funds are overweight stocks. So today, they have to mechanically sell stocks and buy bonds in dollars to get back in balance. And all of this action, it tends to get really concentrated in the last hour of trading, right around the 4 p.m. Eastern close, something traders just call the fix. And here is the absolute key takeaway for anyone watching the market today. This is all about the market's plumbing. It's not about fundamentals. So please, do not read into any crazy swings into the close as some new signal about the economy. It's just the machinery of the market doing its thing. All right, let's move to our third and final story, which really is the one that ties this whole mess together: the incredibly difficult, almost impossible position of the U.S. Federal Reserve.
Just yesterday, the New York Fed President, John Williams, used this very specific phrase. He said policy is well positioned. Now, for anyone who follows central banks, you know that's the clearest possible code for we are not moving, we are on hold, don't even ask.
And this slide shows you exactly why they're on hold. The Fed is completely caught in a classic stagflation trap, right? If they hike rates to fight the inflation from that $112 oil, they risk just crushing an economy that's already getting weaker. But if they cut rates to try and help the economy, they risk letting all that energy inflation become permanent. They have no good options. And make no mistake, the inflation problem is getting worse, not better. The 3-month annualized rate of core PCE, that's the Fed's favorite way to measure it, is now at 3.66%. That is moving sharply in the wrong direction, away from their 2% target.
And as if that wasn't enough, you've got this whole other layer of headwind from the new Section 122 trade tariffs. And this isn't some abstract theory. This is a direct hit to the bottom line of corporate America. We're talking a potential $4 billion hit for GM, billions in losses and absorbed costs for Ford and Apple. It's just another tax on the system at the absolute worst time.
So, with all that as the backdrop, let's just consolidate this into a clear, simple watch list for the trading day ahead. What do you actually need to pay attention to? There are 3 big things to focus on. First, that 4 p.m. Eastern fix. Expect to see some of that mechanical selling in stocks and buying in the dollar and bonds. Don't chase it. Second, keep one eye glued to headlines about Hormuz. Any credible news about a ceasefire could send oil down, and I mean down violently. And third, listen carefully to any Fed speakers. That on-hold message is locked in, so any change in tone, well, that would be a huge deal.
So, to wrap it all up, a war sparked a historic oil surge, which in turn tanked the stock market. And the one group that could maybe do something about it, the Federal Reserve, is totally frozen by the threat of stagflation. This quarter really truly has been a reckoning.
And that leaves us with the billion-dollar question, doesn't it? Q1 is over. Is this the hand traders have been dealt for the next 3 months? That's what the market's going to start trying to figure out tomorrow.